Articles for Car Financing and Leasing, a compilation of resources from NextGen Financial. Know your financing options. You have two financing options when it comes to buying a car. You have direct lending or dealership financing. Direct lending. You might borrow money directly from a bank, finance company, or credit union. In your loan, you agree to pay the amount financed plus a finance charge over a period of time. Once you're ready to buy a car from a dealer, you use this loan to pay for the car. If you choose to finance your car this way, you can comparison shop. You get to shop around and ask several lenders about their credit terms before you decide to buy a specific car. Or get your credit terms in advance. By getting pre-approval for financing before you shop for a car, you can know the terms in advance, including the annual percentage rate or your APR, your interest rate, your length of term, and maximum amount. Take this information to the dealer to improve your ability to negotiate. You could also do dealership financing. You might apply for financing through the dealership directly. You and a dealer enter into the contract where you buy a car and also agree to pay over a period of time the amount financed plus a finance charge. This time, though, you are negotiating directly with the dealer. So the dealer typically sells the contract to a bank, finance company, or credit union that services the account and collects your payments for you. This puts you into a little bit less of a position to negotiate financing terms as you are going directly through the dealer, so you lack a little bit of that control, and you also don't go into shopping knowing what your terms are. Dealership financing may offer you convenience. Dealers offer cars and financing in one place and may have extended hours like evenings and weekends. It might also offer you some multiple financing options because the dealer's relationship with a variety of banks and finance companies may mean it can offer you a different range of financing choices. And maybe they'll give you some special programs. So dealers sometimes offer manufacturer-sponsored, low-rate, or incentive programs to buyers. The programs may be limited to certain cars or may have special requirements like a larger down payment or shorter contract length, 36 to 48 months. These programs might require a strong credit rating, though, so check to see if you qualify before you enter into any negotiations. Here's how car loans work. Purchasing a car typically means taking out a car loan. If you're in the market for a new vehicle, you've probably spent a lot of time researching car options, but do you have a good understanding of how car loans work? When you take out a car loan from a financial institution like a bank, you receive your money in a lump sum, then pay it back plus interest over time. How much you borrow, how much time you take to pay it back, and your interest rate all affect the size of your monthly payment. Here are the three major factors that affect both your monthly payment and the total amount you'll pay on your loan. The loan amount. It can be significantly less than the value of the car depending on whether you have a trade-in vehicle and or making a down payment. The annual percentage rate, usually referred to as the APR. This is the effective interest rate you pay on your loan. The loan term. This is the amount of time you have to pay back the loan, typically 36 to 72 months or 3 years to 6 years. How a lower monthly payment can cost you more. One of the most important things to understand about how auto loans work is the relationship between the loan term and the interest you pay. A longer loan term can dramatically lower your monthly payment, but it also means you pay more in interest. So consider a $25,000 car loan at 3% APR and a 48-month term. Over 4 years of payments, you'll pay $1,561 in total interest on the loan. If you extend that same loan to a 60-month loan or 5 years, you'll lower your monthly payment by $104 a month. But you'll increase the total interest you'll pay from $1,561 to $1,953 because of the extended amount of time. Other considerations. A lower loan amount. Let's say you're considering a $25,000 car loan, but you make a $2,000 down payment or negotiate the price of the car down by $2,000. Your loan amount becomes $23,000, which saves you $44.27 a month, assuming a 3% APR and a 4-term lease. That's because you have borrowed less money, so you have less money that you need to pay back and less money you're being charged interest for. A lower APR. Consider the same $25,000 car loan and let's assume a 4-year term. One financial institution offers you a 3% APR and another offers a 2% APR. Taking the lower APR will save you $10.98 per month.